Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us right now. Here are some of the stories we are tracking for you in the BNN Bloomberg newsroom. Shares of BlackBerry are seeing a surge today after the technology company posted fourth quarter profit and sales that came in above Bay Street estimates, sales jumping 10% compared to the year before. Coming off these results, BlackBerry raised its revenue outlook for the first quarter and issued a full-year sales forecast that beat expectations. The CEO says the company's current position strengthens it against generic AI products. Barrick Mining plans to pursue acquisitions while scaling back exposure to riskier jurisdictions. The shift marks a reversal of its previous strategy and was outlined by Chair John Thornton. Barrick says it will target deals that enhance its base of Tier 1 assets that have long life and low-cost operations. The miner has been looking to reset after dealing with operational setbacks and a management shakeup. It's also currently looking to spin off its top North American assets. And shares of G Mining Ventures are taking a hit, off about 4.5% right now. The company is set to buy G2 Goldfields in a deal valued at roughly $3 billion. The company calls the transaction a uniquely synergistic acquisition that will create a Tier 1 gold mining hub in Guyana. Executives say the combined projects in the region will deliver significant results, adding that shared infrastructure will lower operating costs and increase production. And we'll be joined by the CEO and president of G Mining Ventures, Louis-Pierre Gignac, today at 11:10 to learn more about this acquisition. And taking a look at the markets right now, they are in the red after that big jump yesterday on the Tuesday's news of the truce. But now people are wondering if it's going to last. It's been a bit shaky. There have been attacks, Israel reporting attacks. So you can see the markets are off down in the States. It's similar. They're kind of pushing up, though. They're trying to claw towards green, but right now still down. S&P 500 off by 0.1, the Dow by 0.25, and the NASDAQ by about 0.1 as well. Well, markets are losing some of their gains from yesterday as investors worry whether that ceasefire between the U.S. and Iran will hold. Both sides have accused the other of violating the agreement, and the Strait of Hormuz remains effectively shut. Let's get more from Martin Roberge, Managing Director and North American Portfolio Strategist at Canaccord Genuity. Martin, thank you very much for joining us today. Where do we stand right now? We saw that big jump yesterday. Today, people seem a little more uncertain. Investors seem a little more uncertain.
Yeah, because when you look at the technical structure of the market, and you look at the S&P 500, like prior to the war, the index was trading in a really tight range between, let's say, 6,800 and 7,000. But like in that range, the market was expecting 2 rate cuts. Obviously, price of oil was sub $70. So now you're back up around that 68 resistance, and well, oil is around 100, and people are no longer expecting rate cuts from the Fed. So I think it's just normal to see a pause, and quite frankly, this pause or this volatility should be put in the context that we've had 3 good years in a row, 23, 24, 25. So obviously the market is more vulnerable to shocks, and we just got like a big one, and then questions revolve around the fact or around the possibility of a replay of 2022 when we had the Russian Ukraine war starting, or a replay of April 2025 when we had a tariff relief rally and a market melt up. So quite frankly, odds are about 50-50 on both sides.
Really? Even considering, I mean, wouldn't this be closer to the Russian invasion as opposed to the tariffs?
In my view, Probably yes, but not necessarily, because if you go back to 2022, we had obviously the oil shock, but the Fed and world central banks compounded the rate hikes, that compounded the slowdown or the slowing in the economy with rate hikes. And the reason is very simple: both goods inflation and housing inflation or shelter inflation were rising at the same time. But the thing about 2022 is that labor employment was really strong. We were almost at full employment. This time around, we're facing another oil shock, but this oil shock is different because you've got housing price disinflation or very little shelter inflation. So yes, we're going to see price inflation on goods, but that could be offset by weakening or ebbing inflationary pressures on the housing front. So overall, inflation is likely to be less severe, less broad-based, but at the same time, the labor market is more fragile, more fragile than in 2022. So the risk here compared to 22 is not like a monetary overkill, but the risk that central banks do not cut rates fast enough if we see the second order impact of high energy prices filtering the economy and turning maybe into another growth scare.
All right, so I think the word is volatility then, is what what's going
exactly.
to, I think that covers it right now with the way things are unfolding. Let's talk a little bit about sector rotation. How are you looking at that right now?
Yeah, if I start from the top, I think what we're seeing right now is probably the resumption of the U.S. dollar bear market. So this is a high conviction view here. Like if we're right about this diversification away from trade uncertainty, U.S. trade uncertainty, if we're looking also at probably less petrodollars being recycled into U.S. dollar assets, the pressure will remain down, or the primary trend in the U.S. dollar is down. So you want to be exposed to assets that do well in a U.S. dollar bear market environment. And emerging markets for us is probably the best place to be. But more importantly, if you also believe that we're going to stay in a high energy price regime, you want to be emerging market Latin America, like Mexico, the Brazil. These guys are next energy exporters. So we like LATAM EMs. Mm-hmm. We like, obviously, the hard cyclicals. Hard cyclicals are energy and materials. And those will continue to thrive if inflation is sticky and commodity prices stay elevated. And that's one side of the barbell that we like. And on the other side, the defensives, because as we just discussed, volatility will be around for probably the bulk of the year. And as a measure of or as a shelter or as a refuge, we want to have some defensive exposure in healthcare, staples, and some utilities as well.
All right, and you've got a couple of tech and comm services, XLK and XLC.
Yeah, those are areas that we want to avoid. We have to understand that even though multiples have come down quite a bit in these areas, we are going through a regime shift where these companies now are CapEx heavy companies. They used to be capital light or CapEx light companies. And now we have the opposite, where the cyclical stocks have become CapEx light companies or capital light companies. They're done with their CapEx cycle. And if the history of valuation textbooks is any guide, you don't want to overpay for CapEx heavy companies. And you want to pay more for CapEx light companies. So we're going through this transition in relative valuation, which is aside from what we're seeing through the AI CapEx cycle. Okay, it is just the understanding that the shape of the stock market is totally changing, and the capital-like, CapEx-like companies, which are cyclical companies, will continue to increase or enjoy a boost in valuation and vice versa for the growth or the capital-heavy companies, which will see their valuation compress probably for a little while.
Okay, we have to wrap it up there, Martin. Thank you very much, though, for joining us.
All right, bye-bye.
Martin Roberge, Managing Director and North American Portfolio Strategist at Canaccord Genuity. Up next, G Mining Ventures is acquiring Canadian gold miner G2 Goldfields in a $3 billion deal. We speak with the CEO of G Mining right after the break. G Mining Ventures is acquiring G2 Goldfields for $3 billion. The deal will combine adjacent gold projects in Guyana to create a large-scale mining hub. Let's hear more about the acquisition from Louis-Pierre Gignac, the president and CEO of G Mining Ventures. Louis-Pierre, thank you very much for joining us today.
Thanks for having me.
How did this come about? What made you take a look at this?
Obviously, the G2 Goldfields properties of Oko and Ghani are literally across the fence from our Oko West project. So clearly, this is a transaction that has tremendous synergies, and it was something that we were considering for quite some time.
Now, you're talking about $1 billion in capital and operating cost synergies. Where do you see those savings coming from?
Yeah, those synergies will come from the proximity of these deposits. We'll be able to share infrastructure and operating costs that will result from having a larger operation that we're contemplating. So we see approximately $1 billion Canadian in synergies with a mix of CapEx synergies over the life of the mine and operating cost synergies as well.
And what are you looking at for the life of the mine?
We're looking at something that will extend the mine life of the Oko West project that we currently have fully permitted and in construction now. Something that will likely be beyond 15 years based on the 7 million ounce resource base that comes together with with all these combined deposits.
And will this, with the Guyanese government, is bigger, better? Will this make it easier to work with the government?
We've had tremendous support from Guyana and the government of Guyana. We're fully permitted as we speak, and because this is a bolt-on, we see some synergies there from the permitting perspective, where this becomes an addendum to our current ESIA and permit, as opposed to having to resubmit a whole new, application.
And do you have any neighbors on the other side? Is there another acquisition in the future?
No. Well, this transaction consolidates a significant piece of ground around the Oko West project. So we'll have about 362 square kilometers of land package. So this, becomes district scale, allows for a lot of upside opportunities for us from an exploration point of view. So we're quite excited about the combination that this creates.
And it'll be, you're projecting 500,000 ounces per year. What are the key milestones? What do you have to do to get to that?
Yeah, so with the acquisition, we'll have to do some infill drilling to be able to do an updated feasibility study that we'll aim to complete in 2027. And with that, we'll fully define the expanded project that we'll want to construct. And we would anticipate doing that expansion in 2028 so that it becomes effective sometime in 2029.
And now with shareholders, G Mining shareholders, I believe, are going to own about 80%, G2 roughly 20%. How do you ensure everybody gets along and plays nice?
Yeah, well, I think there's tremendous value for all shareholders, given the very important synergies that come about with this transaction. So we do see tremendous upside with this combined project. Basically, that will create a tier one asset on a global scale with the 500,000 ounce production that these deposits can support.
And now your shares are down about 5% today, 4.3 as I look up there to see. And what do you think some of the concerns shareholders might have or investors might have with this?
I've only received a lot of praise for getting this deal done, to be honest. This is a normal trading pattern that you see when you're offering a premium to acquire another asset. So to me, this is going to be a short-lived as we, fully execute on our plan to integrate these deposits and create significant value for our shareholders.
And now, and that premium, 72%, well above the norm. Why did you go that high? How did you arrive at that?
Yeah, that's a premium that was justified based on the value that we're acquiring with these deposits, and the substantial synergies that exist that are very tangible on this project. So that was a premium that we were prepared to pay, and one that generates significant accretion for our shareholders on a NAV per share basis.
Now that puts some pressure on you over the next 3 to 5 years to perform.
Yeah, well, that's what we've been doing so far at G Mining Ventures. We have our TZ mine that we built on time and on budget. Oka West, that is currently in construction, is on track to produce first gold in the second half of 2027. So we have an excellent team that's been renowned for building our projects on time and on budget.
And with the Oka project, where is the money going to be coming from for it? Is it going to be self-funding?
Currently, we're self-funded for Oka West, and we'll also be fully funded for the expansion that we're contemplating. We essentially have $350 million of an undrawn credit facility at our disposal. Plus, we'll have net cash of $255 million post the transaction, and substantial free cash flow generation from TZ in Brazil.
Do you see any, I asked about next door neighbor, there's no neighbors there, but do you see any more acquisitions in the future right now? Are you eyeing any others?
This is a big acquisition, one that we'll be focused on in the near term here. So, but yeah, like everything, we're always investigating what opportunities may lie ahead, but this really catapults us to become a significant intermediate producer that will already have basically one of the highest growth profiles in the gold sector currently.
Okay, Louis-Pierre, thank you very much for joining us today.
Thank you very much.
Louis-Pierre Gignac is president and CEO of G Mining Ventures. Coming up, today's market drivers with Bloomberg's Monique Molima. We'll see what's weighing on shares of Circle Internet Group today. With gas prices sky high, some are wondering if now is the time to switch to an electric vehicle. They are still an expensive option, and some automakers are even pulling plans to build them in Canada, but drivers can find savings in the long term, though. CTV's Heather Wright has more.
Sam Aldar says the cost of filling up his truck is mind-blowing.
I've been driving in the city for as long as I can remember, and gas prices have never been this high before.
With gas prices across the country at or near record highs, Aldar is among the growing number of people contemplating going electric.
I do think about it a lot.
The EV and Charging Expo in Toronto is all about electrification, from the vehicles themselves to the infrastructure needed to support the shift toward EVs.
We've got really huge and high gas prices right now. And so the cost of electricity, the cost of running an EV is minuscule by comparison.
Nino DeCara is with Electric Autonomy Canada, which organized this trade show. He says while EV sales in Canada fell last year as a number of rebates expired, they rose again in the last quarter of 2025. He predicts the high cost of gas, along with new federal rebates, will nudge new buyers into the EV market, where costs to charge are less volatile.
You don't have these peaks and troughs in your pocket.
According to a study by rates.ca, roughly 30% of Canadians say they are interested in EVs, but the higher purchase cost and charging anxiety remain key barriers to adoption.
So I think part of the reason why adoption rates tend to be higher in Europe is because they have access to affordable electric vehicles.
And while many countries have seen EV sales soar, Canada has not kept pace with its peers. Slow sales and the trade war have led some automakers to pause or scrap EV production in Canada.
The demand that automakers were expecting didn't manifest itself. And so you have seen a lot of automakers make corrections to their manufacturing programs.
Still, industry insiders expect EV sales to pick up. Today, Ottawa announced nearly $11 million for more charging stations across the country, a move aimed at easing at least one of the barriers to EV adoption. Heather Wright, CTV News, Toronto.
Time to take a look at today's market movers. We are joined now by Bloomberg Equities reporter Monique Malima. Monique, thank you as always for joining us. Let's get right into it. We've got a few here. Alcoa on the rise. Aluminum rules.
Yes, so Alcoa, their shares are higher today after Morgan Stanley upgraded the stock on higher aluminum prices. Aluminum prices have been rising since the start of the Iran war as some of the supply out of the Middle East has been constrained. And analysts at Morgan Stanley said that they expect this volatility in the aluminum markets and this constrained supply to continue even with the ceasefire announcement. And they say Alcoa being able to benefit from that and seeing higher free cash flow and earnings as a result of these higher prices, which they say then can be used to pay down debt or to increase shareholder returns. So they see a lot of upside for Alcoa even with the recent ceasefire.
All right. Next up, chemical companies getting a raise.
Yes, so Dow and LyondellBasell were both upgraded today at Alembic Global, and both of their shares are trading higher this morning. The company saw a lot of share price gains during the Iran war as a lot of chemical supplies come out of the Middle East. So as those were constrained, people were looking to the North American and European producers for supplies. But after the ceasefire was announced, both of their shares saw declines. And the analysts at Alembic said that they think these declines are overdone. They expect that even with a ceasefire, if this holds and eventually leads to an end of the war, it would take about 8 to 9 months for the chemical companies in the Middle East to get back to full levels of production. So they see the higher prices and tight supply lasting for the near term, which is going to benefit some of these companies like Dow and LyondellBasell, and also help their free cash flow and their earnings.
All right, I love that name. Okay, we got Chevron. Exxon was saying some issues as well earlier this week. Now Chevron's saying the same, but they're up today.
Yes. So like you mentioned, yesterday, Exxon announced that they would be taking a hit to some of their earnings for the first quarter due to some of their hedging on derivatives and on their lower production in the Middle East. And today, Chevron announced some similar things. They also said that they expect about a 6% hit to production for the first quarter, that some of their hedging resulted in some paper losses. But in contrast, Chevron said that they actually saw quite a large benefit from higher commodities prices in the first quarter, which is going to give upside to their upstream earnings and increase it quarter over quarter. And this is something that analysts see as really positive, which is why we're seeing Chevron shares higher today. Even with the lower production, Chevron is actually expected to see better performance this quarter than potentially what was previously expected. So they say that the higher prices are offsetting the lower volumes, and this is largely due to the fact that Chevron has less Middle East exposure compared to Exxon and some of Chevron's other peers.
Okay, and last but not least, Circle is falling. Compass Point cutting it.
Yes. So today, Compass Point cut their recommendation on Circle to a sell rating, one of only 2 sell ratings among analysts we have tracked at Bloomberg. And this is largely due to the downturn we've seen in crypto markets. Circle is a stablecoin issuer, and while they have seen some of their activity continue even with the lower crypto markets, this has been at those lower crypto prices, which has compressed their margins, which analysts see some concerns around. They also note that the growth that's been happening in Circle's USDC stablecoin has been largely on external platforms that Circle has partnerships with. And on these agreements, Circle gets lower margins compared to when people buy it directly off platform from Circle. So even in the areas where they're still seeing a bit of stability, it's going to be at lower margins. And there's also some other factors weighing on the crypto markets more broadly. The U.S. crypto market structure legislation is still being debated, and there's the potential that it could include a ban on stablecoin yield, which they say would negatively impact Circle. And they think until we see kind of that settled, as well as some returns to normalcy and gains back in the crypto market, that Circle is going to remain under pressure.
Okay, we have to leave it there. Monique, thank you as always. Bloomberg's Monique Malima. Coming up, oil prices are rebounding as doubts over the U.S.-Iran ceasefire fuel new skepticism. What this means for crude and the energy sector is next. The U.S. economy grew at 0.5% annual pace in the fourth quarter, missing the expected gain of 0.7%. Consumer spending expanded at nearly 2%, helping to lift GDP for the period. However, the increase was offset by declines in government spending and exports. For all of 2025, the economy grew 2.1%, the slowest since 2023. Canadian retailer Roots swinging to a profit in its latest quarter. Sales and profit topped expectations. Revenue rose by more than 5%, while margins improved. The clothing retailer launched a strategic review last month that could include the sale of the company. CEO Megan Roach says the company is pleased with the level of interest and engagement in the process. The Royal Bank of Canada is launching a growth fund to invest in Canadian businesses. The fund will invest as much as $1 billion over the coming years with the aim of helping companies build and scale in the country. CEO Dave McKay says the initiative is a key moment to turn Canada's economic prospects and investments around, combating a trend of entrepreneurs leaving the country to access foreign capital. Well, oil prices moving higher today after that big drop yesterday. It's up over 100. It was at 101. Now it's just dipped back a little, but still, it is still up more than 6% for the day. The market, of course, skeptical about the ceasefire between the U.S. and Iran, and there's also the ongoing uncertainty about the Strait of Hormuz. Everybody on edge because of all this. To take a closer look at the volatility with oil, we're joined by Hussein Aladina, Managing Director and Head of Commodities at TD Asset Management. Hussein, thank you very much for joining us today.
Thanks for having me, Roger.
Are you surprised by today where we're seeing oil creep back up over 100 a barrel after yesterday's big dip?
I'm not. I think if we take a look at the noise out of the U.S., frankly, there's been no change to the physical. There's no tankers moving through the straits. I think, the market is pricing a very optimistic outcome. Not surprised to see oil where it is today. Cash markets are trading firm. They haven't exhibited a tremendous amount of weakness. Refiners are still making $30, $40, $50 a barrel. The tightness is real. We do need a resolution because the risk is pretty material here if the straits remain closed. But no, Roger, not surprised. Is this obviously the strait is reopening is the big thing? Is it as important that we have a truce that looks like it's holding as well? Absolutely. If we don't have a truce, then the likelihood that the straits remain open and Lloyd's is willing to offer insurance on tankers is all challenged. I think really, really important to keep this in perspective. Prior to the conflict, we had somewhere in the tune of 150 to 160 tankers traversing the straits on a daily basis. Today we have 5, 6, maybe 8 tankers going through. Rate of change is important, but the absolute level is paramount in determining kind of the commodity balance. Supply relative to demand is quite important. We have a gap today of somewhere in the tune of 10 to 13 million barrels a day, just as it relates to crude. That is multitudes larger than any disruption that we've seen recently. And even in the context of 1973, 74, the magnitude of the disruption today is double what we saw at that point. It's not trivial at all.
And even if it does reopen tomorrow, say, and it's still not automatically, the ships are moving. They have to play catch up, don't they?
Well, in North America, as an example, we haven't seen the impact of the closure as yet. That impact starts being felt over the course of the next week or two, just based on the transit time from the Straits to the U.S. or to North America. Europe is feeling the crunch or is going to start feeling the crunch currently. Asia has been feeling the crunch for the last couple of weeks. So we've been drawing down inventories at refineries because the ships aren't showing up. To your point, Roger, even if tomorrow is phenomenal and there's peace, this disruption plays through for the next 3-4 months in cash markets.
Now, we have seen Saudi Arabia diverting to their pipeline going north, and they've done well with it. Are there other options for OPEC Plus to ramp up the missing middle there?
So Saudi has been able to increase flows or avoid the straits by using the east-west pipeline. There's a pipeline in the UAE, the Fujairah-Habsha pipeline, that goes and avoids part of the south. But again, the magnitude of the numbers here don't add up. You get 7 in the east-west pipeline, you maybe get another 500,000 barrels a day in the pipeline in UAE. There's still a gap in the magnitude of somewhere between 10, 12, 13 million barrels a day. And this is why without the straits open, crude prices have to do the work to ration demand. And the magnitude of the gap, again, is something that we've never seen before. Inventories, maybe for some perspective, inventories in the month of March have drawn in the tune of 5 million barrels a day. There were some folks that were bearish oil heading into the year because they thought inventories were going to build by 1 million barrels a day, 1.5 million barrels a day. In March, we've drawn by 5. April looks like it might be 2.5, 3 million barrels optimistically. We have in the tune of 10 million barrels a day of production shut in the Middle East right now. Again, it's not trivial, and I don't think it's being priced.
And there's no other in the OPEC Plus that could make up for that?
OPEC has spare capacity, but that spare capacity sits north of the levee in the Straits of Hormuz. So Kuwait, UAE, and Saudi all have spare capacity, but they've had to shutter their production because they can't get their crude to market. All
right, now you mentioned about North America may start feeling the effects as those ships are getting here, and then we start drawing down. I mean, we've heard rationing in Asia, Europe. There is talk, they said in the UK, that the last shipment of jet fuel just arrived. Are we in danger of seeing it that severe, or do we have enough that we can cushion it with what we produce?
The severity will be most pronounced in Asia, followed by Europe, followed by North America. Commodities are priced on the margin, so we may not see the need to physically ration demand, but as demand is getting rationed in Asia, as demand is getting rationed in Europe, and what I mean by that, to be clear, is that price does the rationing. We're going to feel the impact at the pump for sure in North America. There's a scenario maybe where President Trump decides not to export crude or product to the rest of the world. That would keep North America or the U.S. Insulated, but there are other sort of ramifications of doing that longer term.
All right, 6 months from now, we've had peace for 6 months. Where does oil sit?
I think the long end of the curve has to price higher. I think the security of supply discussion has changed. I think if you're an oil importing country like India, you're likely to build an SPR, a strategic petroleum reserve, that you don't have right now. 6 months from now, if we have peace starting tomorrow, oil's probably $80 to $90 a barrel.
And if we don't have peace 6 months from now?
So let's pray for peace. If we don't have peace, you have to ration 10 million barrels a day, which is what we've lost right now. That doesn't happen, Roger. I don't think that happens at $120 a barrel. It's probably $150 to $200 a barrel. You're forcing, effectively what you're trying to do is push the world into recession to see oil demand fall by that 10 million barrels a day you don't have. For some context, which might be helpful, during COVID in March and April, when the world was shut, global oil demand fell by 25 million barrels a day. So the magnitude of what we're trying to do here to replace this deficit is absolutely unprecedented, and $120 a barrel oil won't do it.
Okay, we have to wrap it up there, Hossein, but thank you very much for joining us.
Thanks for having me.
Hossein Aladina is Managing Director and Head of Commodities at TD Asset Management. Up next, we'll take a look at the airline industry as airfares continue to be impacted by the energy crisis. Rising jet fuel costs and continued uncertainty around travel are continuing to impact U.S. and Canadian airline stocks. Let's take a closer look at the sector and its outlook with Nicholas Owens, equity analyst for aerospace and defense at Morningstar. Nicholas, thanks very much for joining us.
Thanks for having me, Roger.
It's been quite an up and down couple of days for the airlines. Earlier today, they were up. Now they're in the red. I think a lot of people are running in the red today. Is it going to be like this for a while with everything that's unfolding?
I think a safe answer is yes. I mean, airline stocks tend to be volatile. They're highly levered to small changes in their operations can have a big impact on their finances. And then in this environment, what we're really looking at is this day-to-day kind of seesaw on the oil price, which in the short term, an unexpected change in the fuel price will affect an airline's profitability because they've already sold most of the seats for the planes that are taking off that day. But in the coming, say, weeks or months, they basically pass that on to customers in the ticket price.
And I'm just looking at Delta with that $2 billion fuel hit. The CEO saying is cautious. Could this bury some of the airlines?
I think so yeah, short answer, yes. It's a matter of sort of the weak and the strong, if you will. The Delta being the most profitable airline in North America right now can essentially absorb those costs and pass them on to customers who are, on average, let's say, more well-heeled and less price sensitive than, let's say, a discount or leisure airline. And so there's talk, I think, here, especially if you have $200 barrel oil, like your previous guest mentioned, that would probably cause some of the more discount carriers and distressed airlines to seek a buyer or cut capacity drastically.
And I'm just looking at some of the airlines now, some of the ways they're trying to make the money back, along with adding to the premium cabins. Airline baggage fees. American just added a $50 charge for the first checked bag.
Yeah, I mean, that's probably timed to the fuel, but it's also part of a kind of competitive dynamic that's been going on, which is simply to put a basic fare out there at a reasonable price. So, what I call the back half of the plane of an American jet looks a heck of a lot like a discount carrier. And they have to put that price out there online and be comparable. And then, you charge extra for the other stuff.
And is there any other ways for them to try and offset these fuel increases other than passing it on to the passengers?
Well, when push comes to shove, the airline has to also respond to what its competitor does. And so, let's say, in a perfect world, which is not the one we live in, the airlines would pass the fuel cost on in the future ticket prices. But if a competitor does not do that and chooses to offer lower fares, then an airline is forced to match those fares. And so that's where, let's say, a weaker airline would potentially erode profitability for the whole industry.
Now, and we're hearing some airlines cutting routes, I think more in Europe and elsewhere, for savings, just because of the fuel issues. Do they lose money with that, or sometimes do they actually save money or even make money when they do that?
Well, that's a great point. So a spike in fuel costs like this drives the cost of operations up for every airline. And so what was maybe a marginally profitable route from X to Y now becomes unprofitable. And it's a prudent decision to cut the schedule or cut the route altogether if you're losing money on running that plane.
And I guess the big question, if we do see things settle down in the Middle East and prices drop, how long before we start seeing a break for passengers, or will these be things that maybe stick?
Well, I would expect, it's kind of a little bit like, I guess, Monopoly, $200, don't pass go. On the way up, the prices are passed on immediately. On the way down, it might take a little while, especially because the crude oil price, which is the one people are focusing on related to Iran and the Straits of Hormuz, that plays through to also the what's called the crack spread of turning that oil into kerosene, which is what the jets burn. And so it may take, even if, let's say, everything went back to normal and peace broke out tomorrow, I would expect the kerosene price to stay a little bit higher for several months.
And just one last quick question. Any airline stocks you're keeping an eye on that you're liking?
Wow. Well, there's a ton of uncertainty around these. We have them all rated as high or very high uncertainty. It does seem that Air Canada and American are a little bit undervalued, and I think that's because they're kind of playing catch up to growth plans and going after those high premium customers compared to your United and Delta, which actually I see is overvalued at the moment.
Okay, we'll wrap it up there, Nicholas. Thanks very much for joining us.
Thank you.
Nicholas Owens, equity analyst for aerospace and defense at Morningstar. Coming up, we're watching shares of BlackBerry today after the Canadian software company beat their most recent earnings. We'll break those down when we come back. Shares of BlackBerry are surging after the Canadian software company beat first quarter estimates. The turnaround is gaining traction, helped by strong demand in its cybersecurity and embedded software businesses. For more on this, we're joined now by technology analyst and journalist Carmi Levy. Carmi, thanks as always for joining us.
Good to be with you, Roger. Thanks for having me.
Okay, BlackBerry, are they getting their feet underneath them?
They certainly are. I mean, it's been a really long road. This was the darling of the smartphone market. They literally defined smartphones before they were eclipsed by Apple and then later Google. And so they're a fraction of their former size. They've gotten out of that business. Obviously, they are now into automotive embedded systems, security software, secure communications. So it's taken them a while to establish themselves in these new markets and start getting momentum. But clearly, looking at the numbers from this morning's earnings call, it's obvious that they're starting to execute on those years of promise that, to the point that the CEO, John Giamatteo, now saying that they are now a growth company, that both of these key sectors where they operate, they are now exhibiting solid growth with solid internal execution after years of kind of rearranging the deck chairs. And now they're starting to gain momentum in both of these markets.
And what's caused that change?
I think part of it is internal discipline. So they cut costs. They got out of businesses. They sold their Cylance division, which was a drag on their growth. They've invested in their QNX embedded technology to remain and remain competitive in the space, and they're being recognized for it. And so they've essentially, they went on a diet, and they're finally in shape. And so they're also being recognized by key customers in those spaces. BMW has chosen them to underpin the architecture for their next generation new class vehicles. And on the security side, the federal government has now engaged them for their SecuSuite package. They were using it already. Now they're expanding that relationship for a digitally sovereign, secure communications solution going forward. And they're also benefiting from some external, the external factors. Defense spending is expected to increase significantly, so the need for secure communications in these spaces, both in Canada and globally, will continue to grow. So they put themselves in the position that as market conditions evolved, they were ready to capitalize on them, and now on both sides of the business, they now have that well-earned momentum.
And what is the QNX system? It sounds like that is going to be their base. That's their lifeblood right now.
It will be. And so, that division, record revenues this last quarter, continuing to grow, beat expectations, high margin business as well. And so basically what they do is they provide the software that powers vehicles. And this is increasingly important as the industry shifts toward what's called software defined vehicles. So rather than just having a car that has a few different software systems on it, you literally design the car as a rolling computer, and it's the and the features get rolled out in software, not in hardware. That is where QNX has always been a key leader. It's why BlackBerry bought them all those years ago, and it's why it has become the very driver of BlackBerry's growth going forward. Of course, we know the automotive industry is facing some pretty significant headwinds thanks to trade uncertainty in the U.S., thanks to concerns over what's happening in the Middle East. It's very possible that the automotive sector will have a few bumpy years, which could prompt some vendors to put off those investments in software-defined vehicles and architectures. But at the same time, when they're ready, QNX has shown it's willing to make those investments in this technology to be the market leader, so that even though there is intensifying competition and other automotive vendors do have more choice, QNX still has a technology that was always known as a pioneer in the space, and it continues to lead in terms of features and capability.
What are you going to look for over, say, the next 6 months or a year that gives you a little more confidence that this turnaround is solid?
I'm going to look for, so right now we have a couple of, so the federal government deal, for example, on secure communications, that gives them additional go-to-market credibility. So will they be able to secure other deals with other governments, not just in Canada, but globally, as they dig deeper on their defense investments and need more secure investments? Are they going to be able to convert that initial win around digital sovereignty into market momentum? Same thing with QNX. BMW is an early and significant win. What other automakers are they going to be able to secure in the months to come to show that neither of these was simply a one-trick pony, but they are using it as a way of building sustained businesses around these two cores?
All right, I got to wrap it up there. Carmi, always a pleasure to talk to you.
Appreciate it, Roger. Thank you.
Technology analyst and journalist Carmi Levy, and I still miss the keyboard. Market calls coming up next today on the show. We have Lyle Stein. He is president of Forvest Global Wealth Management, and we'll be taking your questions on North American and global stocks. Thanks for watching Morning Markets. I'm Roger Peterson. We'll see you back here tomorrow.